So you think you know a lot about private equity, eh? Well, we're going to test your knowledge. Today, we have 3 questions for you on private equity fund investing. So let's get started. Question number 1. Which of the following is the best way to ensure that the private equity fund's investment team's interests are aligned with the investor's interest in the private equity fund? A. The investment team receives a large bonus if certain revenue targets from the portfolio companies are met. B. The investment team receives a payout only if the net income of its portfolio companies is positive. C. Each investment team member has a significant investment in the private equity fund. Or D. Each investment team member has options in the private equity firm stock. The answer is C. The team has a significant investment in the private equity fund. While meeting revenue targets is important, it does not account for margins. While focusing on net income is helpful, it does not account for cash flows. The best answer is for the team members to have skin in the game in the private equity fund that the investor is investing in. In other words, each investment team member has a significant investment in the private equity fund. Now, while having options in the private equity firm stock does align the interests of the investment team with the firm overall, the question was specifically related to a private equity fund. To learn more about what to look for when investing in the team of a private equity fund, please check out our video titled 7 Things to Look For When Investing in a Private Equity Fund. Okay, so let's move on to question number 2. Which of the following metrics is least frequently used by a private equity fund when communicating to investors about the target size of the companies to be invested in? A, EBITDA, B, cost of goods sold, C, revenue, or D, average check size? The answer is B, cost of goods sold. When a private equity fund states its strategy, it will do so by stating its sector, geography, and target size of the transactions. When identifying the size of the transaction, most of the time the private equity fund will identify the size by stating a range in EBITDA of the target company, or maybe even a range in revenue. For example, the fund may target firms that have 10 million to 20 million in EBITDA, over $100 million in EBITDA, or over $1 billion in revenue. Now, sometimes when informally talking to investors, private equity funds may tell investors that the average check size is a certain amount, such as saying the average check size is $10 million. This refers to the equity amount, or in other words, the size of the check that the private equity fund will be writing. As for cost of goods sold, well, that is not used to define the size of the company. To learn more about what to look for in a private equity fund's investment strategy, please check out that same video we mentioned earlier titled 7 Things to Look For When Investing in a Private Equity Fund. Okay, so let's move on to question number 3. Which of the following is not a drawback when investing in private equity over public equity? A, higher minimum investment required. B, larger fees. C, lower levels of liquidity. Or D, ability to earn excess returns. The answer is D, ability to earn excess returns. The first 3 answers are all drawbacks of private equity over public equity. Private equity has a higher minimum investment required, larger fees, and lower levels of liquidity. Selling on the private market is a lot harder than selling on the public market. With that said, private equity has the ability to earn excess returns. For more details on the pros and cons of investing in private equity, please see our video titled Private Equity Fund Investing, Pros and Cons. Those are the 3 questions we have for you today. How'd you do? Please let us know in the comments. And while you're there, let us know if you have any recommendations for future questions. We'll be posting more quiz videos to test your PE knowledge. So remember, hit that subscribe button.